But from a macro standpoint, I do want to show you, I've reworked a lot of what I've been looking at. I think employment is the most important thing going on right now. And while some of these metrics, this is 3-month annualized numbers right there. And if you see year over year, it's year over year or quarter over quarter, but mostly 3-month annualized is what I'm looking at. It's just the early trend, the trend within these metrics that tends to lead towards the targeted year over year number you want. In order to have a year over year number at 2%, you need to see multiple 3-month annualized prints at 2 or below, right? So anyway, employment has been hanging in there. And then all of a sudden we start seeing temp jobs crater, and it continues to crater. That's one of the early leading indicators to employment going down. And now continuing claims is going down and confirming, looking quite recessionary. And the one that's the most important from the work I do is initial claims of unemployment on a 4-week moving average. And it's just been hanging in there. You can see it's been negative, it's been good. And then all of a sudden we got our first big print, 3.6%. And so that's concerning. We have continuing claims and temp jobs, which are good leading indicators towards employment falling apart. And when employment falls apart, you're in a recession. That's basically, they go hand in hand. I don't think there's a recession where employment stays solid. Basically, recession is a lot of people lose their job around the same time, and it just snowballs, right? There's another leading indicator that I look at, which is employment comp received on a year-over-year basis, and then subtract that from the active Fed funds rate. And this has a pretty interesting history with few false positives. When it goes negative, in other words, when the Fed funds rate is above the year-over-year reading on employment comp received, you tend to either be already in a recession or very close to one. Now, it's given a few false positives, not many. One of them was in February. It had the same reading we see right now, that 0.1 reading. So take it as you will. I think the deteriorating employment market has us closer to a recession than I think most think. So the macro has me concerned right now. We're seeing deteriorate. The resilient U.S. economy is not as resilient as it once was. And the other thing that I believe is that a lot of people look at credit and they'll show like, credit has been one of the main drivers of recessions and growth business cycles. And this one right here that we're in, I believe, is more driven by income than credit. And so this has been very crucial to follow. And we're seeing our first chink in the armor, if you will, around household income, for example. On checkable deposits received on a year-over-year basis, our first negative print. You have to go back to March of 2020 in order to find that, and that falls in line with real disposable personal income on a 3-month annualized basis, giving us our second month in a row of negative readings, right? So now we're seeing incomes are not keeping up with inflation and in prices, and it's falling in line with consumer sentiment hitting somewhat of an alarming reading after being very positive for the last few months. So my point being is the economy in the U.S. appears to be deteriorating faster than most people think. And so the resilient U.S. economy theme, I don't think is going to last another 2 or 3 months.